Let me clear up a mistake I hear all the time. People say, Greg, why don't I just skip the fees and put my money in an indexed fund? Well, an index fund and indexing inside an IUL are not the same thing. And if you don't understand the difference, you can lose years of progress trying to recover from just one bad decade. Hi, I'm Greg Kite with Championship Wealth. I help people optimize their financial, intellectual, and foundational assets. I help families optimize financial assets, and when I say optimize, I mean a few things that I look for. I look for liquidity, safety, rate of return, and tax advantages. Today I'm going to explain how an IUL account really works. In plain English, no hype, no jargon, just clarity.
Greg, Kite.
Things worked out and grab a little life, bro. When I set aside serious money, I wanted to do 4 jobs at once. Number 1, I want it to be liquid. I can access it whenever life happens. Number 2, safety. I don't want to lose my principal. Number 3, competitive returns, historically able to outpace inflation. And number 4, tax advantages, because taxes are a silent wealth killer. Most people only chase returns. That's like building a championship team with only scorers and no defense. You might win a few games, but you won't win the season. Let me give you a simple example. Let's say John, a 60-year-old, comes to me with money in 3 places. He's got $300,000 in an IRA or 401k. He owns a rental property that he's tired of managing. And he's got $100,000 sitting in a bank earning cute interest while inflation runs laps around it. He says, Greg, I want my money working smarter. Here's the reality. The IRA or 401k money, it's not all his. When he pulls it out, taxes show up like an uninvited guest. So if we do this strategically over time, maybe that 300,000, say, nets around 200,000. Then if he sells the rental and nets another 200,000 and then takes $100,000 that's in the bank, now we're looking at $500,000 of money that he wants to reposition. Why I love the LASER concept is in the acronym that is its name. LASER stands for Liquid Assets Safely Earning Returns. Think of an IUL, an Index Universal Life Policy, like a bucket, designed to do multiple jobs at once. It holds your money, it protects your principal, it earns interest linked to an index, and when structured properly, it offers powerful tax advantages. And here's the part most people don't know. You can't just dump $500,000 or $50,000 or $100,000, whatever it may be, all at once into an IUL and keep the tax advantages. The IRS has funding rules, and this is where structure matters. If you put too much in too fast, you can actually trigger what's called a MEC, a modified endowment contract, and that can change how withdrawals are taxed. And we don't want that. So in real life, let's look at this illustration. The money is typically funded over a few years. Depending on the age and design, it might look like this. About $93,000 in year 1, the same in year 2, the same in year 3, 4, and 5, and then in John's case, the rest at 5 years and 1 day. This pacing keeps the strategy working the way it's intended. Let me say this clearly. This strategy isn't a product. The strategy is the structure. Now here's where you may need a change of thinking. With a properly structured index universal life policy, you're not buying the most insurance for the least premium. That's old school thinking. Instead, you're buying the least amount of insurance allowed to maximize cash value growth. So $500,000 might require roughly $1 million of death benefit depending on the person. And why do we do this? Because of something called the net amount at risk. So in other words, if your death benefit is here and your cash value is here when you start, as your cash value grows, the amount of risk between the death benefit and the cash value shrinks, which means the insurance company is insuring less over time. That's how a policy can become more efficient as you get older. Now let's talk about indexing. Inside an IUL, you're not buying the S&P 500. You don't own shares. You don't ride the roller coaster. Your money stays in the insurance company's general account. Then you choose how the interest is credited. Here's the simple version. If the market goes down during the crediting period, your return can be zero, but you don't take a direct market loss to your principal. If the market goes up, you can be credited interest based on that growth, subject to the rules of the strategy. So you're playing a different ballgame. You're aiming to avoid big loss years and still capture the gain years to win big long term. If you've ever watched someone lose 30 to 40% on their account, then spend years trying to get back to break even, you understand this. In wealth building, not losing is a superpower. In money, in finance, and in sports, defense wins championships. If this is starting to click and you're thinking, okay, Greg, how would this look with my money, my age, and my goals? Here's what I recommend. First, get educated. I'll send you a free copy of my friend Doug Andrews' book, The Laser Fund, that explains this strategy in clear, simple terms. You can order this book by going to championshipwealth.com/books. Second, you could register for and attend one of my free virtual workshops. You'll get more information about optimizing wealth. Third, if you want to talk, book a call. We'll look at what assets you might reposition, the tax impact, and whether this even makes sense for you. No pressure, just clarity. You can do that at championshipwealth.com, book a call. Again, if you'd like to order a free copy of the Laser Fund, just scan this QR code and I'll ship it out to you. All that I ask is you chip in for the shipping and handling. This isn't about selling you something. It's about helping you stop losing ground, stop guessing, and start building championship wealth for you and your family with a strategy that fits your life. Let's win a championship together.